Well, we've just seen the end of the third quarter, the March end, and for the financial year to date, the market's up around 25%. So it's been pretty good. It's been a pretty good market for this financial year so far. When we look at the valuations in the market, the PE for the full year 14 year, given that we're pretty close to the full year 13, for full year 14, we're looking at 15.5 times, which is probably just at the upper end of fair value. And we need about 11% growth for 14 on 13 to get to that 15.5 times. So not after a fairly subdued few years in terms of profits for the industrial companies, that's not a massive ask given where interest rates are. And the last reporting season showed that some companies were seeing a slight, and I emphasise slight, because it certainly wasn't uniform and it wasn't, they weren't calling it out massively, but they were seeing a slight upturn in demand in some of their end markets. We've seen a bit of a rebasing in the retail markets, in the retail stocks. Some of those stocks that had been heavily hit hard, DJs, Myer, Pacific Brands, have really started to seem they've found a base, and potentially from here, the consumer may come back into that retail market, and this wouldn't surprise with where interest rates are at these low levels currently, and may even go lower over the rest of the time. Having said that, though, we're not seeing a lot of value, in the market. We're not seeing a lot of cheap ideas. And so we've been, selling, taking a bit off the top, selling down some of our very strong performers, and raising a bit of cash. Or having said that, of course, there's always opportunities in the market, and we're seeing those in a couple of big block trades that we've taken advantage of in the last few months. The first one being Sky TV, which is New Zealand's only pay TV operator, monopoly business, a very good business. In that market, there's very little anti-siphoning of laws that's prevalent here in Australia. So a good business, and we bought that at a good discount. We're able to be an anchor position in that sell down, and that performance of that stock has actually exceeded our expectations subsequent to that sell down. The other big sell down was Horizon, the old QR National. Again, the government selling down at market. At this price, Horizon is no bargain, but we think it's a good medium, longer term story. The monopolistic below rail assets, it's a good way for us to get exposure to infrastructure type assets. They may be able to do something with that below rail asset in terms of maybe some kind of financial engineering, value adding sale, or repackaging of it in some way, which could increase value. But we think it's a slow grind for that business for the next couple of years, but hopefully we think a successful one for the investors in our funds. The big sectors of the market, resources and banks. Banks have had a fantastic financial year to date, very strong price appreciation as investors have really looked for that yield out of those banks. Now we think they're full to fair pricing. Resources, on the other hand, have not fared as well. Their prices have fallen back, and really on the back of uncertainty, on the demand side coming from China, and also the supply side. There's a lot of iron ore hitting the market, coal around the world as well. Quite a bit of uncertainty both on the demand and supply. But this is, to us, is where the value is starting to appear interesting, is on that resource side, particularly only to us in the big tier one companies. Whilst the banks, for us, those dividends look okay as long as everything goes okay. But we think it's going to be difficult for too much more price appreciation from here.